The U.S. housing market has been silently watching the uncontrolled growth of a nationwide home price bubble over the past few months. However, third-quarter numbers suggest that the market may have been stretched to the limit as home sales significantly collapsed for the first time in almost 18 months due to sky-high prices and the prospects of higher interest rates. Worsening affordability means that fewer Americans can actually make the dream of owning a home come true, and as a result, the market slows down and prices start to come down to earth again. The latest reports indicate that we're at the end of a euphoric market and a downward trend is right around the corner. While home prices have recorded meteoric rises all across the nation, household income has dropped. Consequently, home ownership became out of reach for many potential buyers. It has become nearly impossible to find a home costing less than $200,000, even in rural areas, according to an analysis by John Burns Real Estate Consulting, which found that the inventory of affordable homes in America represents only 20% of all U.S. real estate right now. Or, as the director of research at John Burns, Rick Palacois Jr. has put it, cheap homes are like unicorns. In the past 10 years, the median home price rose about 30%, while incomes increased by just 11% over the same time period, and that's according to a bank rate analysis of data from the National Association of Home Builders and the Wells Fargo Housing Opportunity Index. But by analyzing the past 5 decades, the difference is even more shocking. From 1962 to 2020, home prices shot up by 416%, according to Motley Fool's estimates, while household incomes have only surged by a dismal 15%, according to census data. Today, the median home price in the United States is roughly $374,900, with prices jumping by almost 20% from 2020 to 2021. To afford a home in 2021, Americans need an average income of $144,192, which is considerably higher than the median household income of $69,178. That means the current pace of home price growth is not sustainable for much longer. If prices continue to rise at such a fast speed, there simply won't be enough buyers left in the market, especially when interest rates start going up. As the Fed rushes to fight against runaway inflation, its tapering program is scheduled to start by year's end, and artificially suppressed mortgage rates will begin to soar in the coming months. Rising interest rates would be especially harmful if interest expenses on homes rise faster than salaries, noted Bryden Hill, president of Weber Global Management. In face of rising rates and a liquidity-drained market, there will be no other alternative. Skyrocketing home prices will have to readjust and meet our economic reality. In other words, even though people are too conservative to bluntly say it these days, the U.S. housing market is set for a crash. That's what Ivy Zelman, a housing analyst who became famous on Wall Street for calling the top of the 2008 bubble, has warned in a recent interview. Zelman revealed that she's seeing several red flags once again. In less than 2 years, the U.S. housing market has seen a historic run-up in property values like anything we've ever seen before. But now, we're at the peak of the bubble. In less than 2 years, the U.S. housing market has seen a historic run-up in property values like nothing we've ever seen before. But now, we're at the peak of the bubble. She's alerting her clients that overheated areas with heavy concentrations of investors are likely to face corrections, the industry's term of choice, not to spark panic on the public. But in essence, we all know that corrections stand for sharp crashes in overinflated property values. Zelman says that even a small rise of 1%, setting rates at 4% would bring demand to a halt. In a recent interview with Bloomberg, she said that cracks are already appearing everywhere. In boom towns such as Boise, Idaho, and Salt Lake City, the market is already hitting a wall as sales rates fall. Bidding wars are suddenly giving way to discounts because people can't keep up with the pace of home price growth anymore. The analyst says that today's fundamentals are different from the last bubble, which was supported by risky subprime mortgage lending. But the signs of trouble look familiar, she says. Investors are distorting the market by driving up prices beyond the reach of primary buyers, and builders with growing construction pipelines are bidding up land values. The risk is that investors acquiring and building single-family homes for rent might get spooked and start selling, overloading the market with supply. By the time builders finish homes they've now just started, demand may no longer be there, Zillman says. If I'm a home buyer right now, I want to wait because I think we've gotten to a level that's not sustainable, she added. The analyst is also a former Credit Suisse Group analyst and co-founded her own firm, Zelman & Associates, disclosed to Bloomberg that this is the first she is calling the top of the housing market bubble since the last crash. It definitely is the first time that I've been concerned about the market being at peak levels since the last downturn. Absolutely. And our concerns are obviously not very much the party line. We are the contrarians. Our views are grounded in fundamental research and understanding, she says. Given that the Federal Reserve has signaled that it will start to roll back its bond purchasing program and raise rates in the coming weeks, Zillman says that some of her predictions may not come to fruition this year, but probably early in 2022. But we definitely see a storm brewing, she continues. The analyst argues that excess liquidity in the markets have led investors to fuel a speculative bubble in the housing sector, with iBuyers, private equity firms, and sovereign wealth funds propping up property values in an attempt to collect higher returns. It's really a function of when does pricing hit a wall, and when do you start to see pushback, whether it's affordability or just buyer fatigue. I'm concerned that the market is definitely artificially inflated by investors. Prices are not sustainable anymore because returns have started to flatten out in many markets and others are already facing mounting pressure, she says. I think what we are concerned about is that the normalized level of demand is being clouded, which is cutting this perception that we don't have enough inventory because of all the second homes that people now own, as well as investors, just driving up pricing. If you've got iBuyers, and you've got fix and flip buyers, and you've got private investors trying to diversify their position away from just owning equities, you're going to have a lot more difficulty delineating true primary demand versus what I call just non-primary demand, she explains. Now, the biggest threat in the market is that a rate hike will depress affordability even further. The terrible Fed policy of continuing to purchase mortgage-backed securities at $40 billion a month has kept rates at artificially low levels. The backlash of that is that it's going to impact mobility because when you look at the number of homeowners that are locked in, not at 4% but below 4%, we're talking almost 70% of mortgage holders, Zillman highlights. Right now, the benefit of the arbitrage is still there. If you can buy a home, get a rate lower than where you were locked in at, and you have a higher home price that you have to digest, that's offset by the lower rate. If you have higher home prices plus higher rates, it just disincentivizes mobility, she explains. When asked if she sees a housing market crash coming, the analyst warned that property values have to go down. There are going to be corrections, and I think there are going to be corrections that are even more pronounced if rates go higher than 1%, she cautioned. Just like Zillman, Many others in the market are also suggesting that the third quarter of 2021 likely marked the peak for the housing market's price bubble, and from now on, real estate prices are bound to collapse. In many cases, the drop will likely be a painful one. According to economists at Fannie Mae, housing inflation is expected to drop by at least 2% this quarter as the bubble loses some steam. The industry consensus right now is that there's no way to support the continuing rise in home prices. Many factors that are driving this cooling trend in home prices are related to inflation, or what inflation means for the market. Consumer prices have been rising at the fastest pace in nearly 30 years, so our policymakers have no choice but to turn off easy money policies that have supported the creation and the growth of numerous asset bubbles over the last 18 months. According to the Mortgage Bankers Association, the average 30-year fixed mortgage rate will hit 4% by early 2022, and that will effectively lock some buyers out of the market altogether and put downward pressure on prices. Already, due to increasing affordability challenges and the estimates of higher mortgage rates, home sales fell 5.8% from a year ago. Fresh data from the National Association of Realtors point that actual sales of all types of existing homes fell 8.2% year over year to 526,000 homes, and sales of condos and co-ops dropped by 8.1% year over year to 57,000 units. Considering today's sky-high prices, the housing market is much more susceptible to higher mortgage rates than in prior years, which means that property prices will have to sharply readjust to reduce the affordability gap. Some industry cheerleaders can say that today's overinflated prices are a matter of simple supply and demand. But the truth is that demand means having buyers who can actually afford to buy. Unfortunately, those who entered the bubble thinking they would have massive returns are set to disappointment. Millions of Americans are about to see the value of their homes dramatically crashing. Just as every bubble artificially inflated by the Federal Reserve over the past year, the housing bubble is headed to burst, and that meltdown will begin as soon as interest rates start going up.